silver is most definitely on the march again. But in 2011, silver didn't collapse because people stopped believing in it, per se, but it collapsed because the positioning broke. In 2020, oil didn't go negative because the world ran out of drivers or ran out of uses of oil. It went negative because the plumbing just snapped, just like that. And right now, silver isn't rising again because the world suddenly loves coins or coinage or silver stacking. It's rising because of positioning and, most importantly, because of gamma in option markets. Most people think that price moves because buyers and sellers, etc., but that's actually a bit of a myth. The reality is far more mechanical and structural. And by the end of this video, you'll see exactly where the pressure leaks, exactly why the silver market is rising again, and most importantly, how we can position and get in on the gravy train. So what's the story that you're commonly told about silver, about precious metals in general? You're being told that the silver move is about inflation fears, the cost of things, war risk, industrial uses of silver, central banks buying the metals, retail stacking all of the silver known to man out there in existence so they can get onto the gravy train. And all of that, quite frankly, sounds very reasonable in my opinion. But there is a problem with that thesis or those theses. Retail doesn't actually move futures markets. I mean, it would be great if we did. I count myself as a retail trader. It would be great if we did, but in reality, we don't really move those markets. Coin collectors, as lovely as they are, don't move volatility surfaces in option markets. And inflation narratives don't create 3-day vertical ramps of exponentiality and parabolas in the price action. Positioning does that. Gamma does that. Delta does that. Skew does that. Optionality does that. And when the positioning gets really extreme, markets stop behaving like those markets. They start behaving mechanically, like machines. So the best way to talk about this is to use a story, use an analogy or an anecdote or a parable. Well, maybe not a parable, but let's simplify it using a narrative device, a figurative device. Imagine you're in a casino. Now, I know some of us treat the financial markets like a casino, but just humor me. Imagine we're in a casino. You walk in and you place a big bet on silver going up. The casino doesn't hope that you lose, it hedges, it bakes in the probability of you losing. And that's exactly what options dealers actually do. If you buy calls on silver, the dealer sells you the call. They want your money, of course. And the probability is that most of the options are going to finish out of the money and you're not going to get the payoff reward. Now, the dealer is short the upside exposure. They've sold you the call, which means they have to hedge that upside risk. To protect themselves, they have to go into the futures market and then buy silver. Makes sense, right? That hedge pushes up the price though. Them buying the hedge has to put the price up because they have to buy the futures. It means mechanically the price has to go up. So when they're selling you a call, the price is being reinforced by them hedging themselves in the futures market. And what happens? A multiplier effect. As the price rises, the dealer becomes more and more exposed. So they have to buy more and more to hedge their books. And that's what causes the sensitivity. That's what causes the acceleration. And that's what we call gamma. I know it sounds like something from the Hulk or something radioactive, but it's not. It's gamma. And when enough calls cluster at certain levels, the prices don't just drift in a diplomatic, polite fashion. They snap really aggressively and really violently. And that's what poses the major threat in these financial markets, and particularly in thin, liquidity-drained markets like silver. So let's talk about the threat a little bit more without being alarmist, sensationalist, nihilistic, or catastrophizing it at all. When markets move because of gamma, because of option positioning, the move can be very quick and the move can be very violent. It's often said that in oil markets, oil prices supply shocks, but precious metals price in trust shocks. And that's why the reverses can be so violent, because once those options decay and the value decays, the positioning has to reset. And these options chains, if you've looked at them, they decay really quickly. And there's various options around various prices, which means there's constant rebalancing of flows, re-hedges and re-exposures that have to be covered, essentially. What's left though? There's nothing underneath once that happens. That's when the air pockets can really form. That's when the collapses in the price can really happen. And that's why you can see silver plummeting like 40% in one day or over a few days. Collapses, cascade upon cascade, the orders cascade upon orders, they multiply, and the effects becomes even more powerful. So silver in 2011 dropped 30% in a few days. Similar, but less of a magnitude drop. But not because humanity and all of their friends stopped believing in the metal, it's because the leverage had to unwind massively. Open interest had exploded, which basically means many people were interested in the market and had opened up calls, and there was more of a skew towards people buying upside optionality than they were buying downside possession. Now, what happened then? The positions had to crack. The plumbing mattered more than the story. And that's what always happens. The narrative, the thesis might be completely correct. You might be pricing in a catastrophe in the future. You might be pricing in a bottleneck in terms of supply. You might be pricing in inflation or forward rate expectations. But when the positioning cracks, that's what really matters. Silver open interest on COMEX has recently surged to multi-month highs. And call skews has steepened, which means people are buying more calls essentially. Implied volatility is rising with that price and it's not falling. That's abnormal in these markets. In a healthy rally, vol is going to compress. What does that mean? It means the scale of the moves are not inordinate. The scale of the moves are not violent. But in a gamma-driven rally, the volatility expands rapidly. Why? Well, because our friends or our enemies, the dealers, are chasing that upward move. They're chasing the hedge. They're chasing their exposure. They're selling you calls with alacrity. They love selling you calls because it makes them money, and most of them finish out of the money. But they have to hedge it, and that's why they're chasing it, and that's why gamma becomes so important. This isn't grandma buying silver bars or grandpa buying coins for his future grandkids, or because he doesn't trust the United States government or the equivalent around the world. It's other institutional flows, big money, CTAs, hedge funds. Now, there are a lot of historical parallels in this market, and that's what gives birth to the theories that silver is hugely manipulated, or this conspiratorial theories that silver is hugely controlled by certain entities. Because the same thing happened in 2011 when retail piled in, but more importantly, the leverage was exposed again. Options activity again in 2011, just like now, they surged. Futures open interest ballooned, just like then, happening again. Margin debt was in the extreme. Then the CME, the Chicago Mercantile Exchange, raised margin requirements repeatedly. Does this sound familiar? Of course it does. And just like then, just like now, the gamma flipped. Dealers stopped buying. They started having to sell. Silver collapsed 35% in a week. Again, does that sound familiar? Of course. Now, past is not prologue, but hey, it rhymes, right? Silver collapsed 35% in a week that time. It wasn't that belief change. The narrative didn't change. The story didn't change. The thesis didn't change. The fundamentals didn't change. It was pure mechanical plumbing in the system and positioning. Now, if you don't believe me, there's even more historical parallels. Now, I'm not going to go all the way back to the hump buffers, but you could do if you wanted to. But in 2020, something else happened in April. Oil went negative. Now, did the planet run out of a use for oil? No. Were we swimming and drowning in oil? Again, no. Storage constraints meant leverage position. Option structures forced the hedging flows again. Dealers had to dump into illiquid markets, and that literally sent oil negative, something that was anathema to economics 101. The system completely broke, and it was all because of hedging flows and option flows. Price didn't reflect what actually was valued. Time value of money and the value of actual resources that are in demand no longer mattered. It reflected only the plumbing. The plumbing mattered more than the actual realities on the ground. Now, let's be honest, you might look, let's use an analogy as your body. You could look as healthy on the surface on the outside, but if your arteries are clogged, that's the plumbing that matters, not the ebullient, beautiful, radiant face on the outside, right? Now, silver today is showing these signs of an upward pressure. But why are people still confused about it? Why are people still sitting on the sidelines? And why are people still saying silver could collapse, even when the escape velocity is seemingly met? Now, people in markets are emotional, and that's partially true, and that's partially needed. But most short-term moves are definitely not emotional. They are structural in nature. You're not trading the sentiment. You're trading the exposure, the hedging flows, the exposure, the deltas, the gammas. You're trading the mechanical system, the plumbing underneath that is directing capital into these markets. And that exposure has a finite time period. It has a half-life, just like something radioactive. A little bit less dangerous though, you'd imagine. Or maybe not, in whose hands? Weapons of mass destruction and all derivative markets. The reason retail always feels late is because retail reacts to price rather than positioning flows. Retail rarely looks at option data, rarely looks at skew, rarely looks at capital flows, rarely looks at how stretched the positioning is coming. And obviously they don't have the data to show people how much dealers are having to delta hedge. Gamma is the real force behind most of these markets. It used to be a case that the prices led the options market, but now the options are leading the actual pricing markets. So if that's a bit confusing, let's simplify that all again. Let's move backwards in time and backwards in reality. If dealers are short 50,000 silver upside calls, every $1 move increases their exposure, obviously. The delta has to increase. So they must buy more futures to stay at the same place. Not going forward, not going backwards, but to stay neutral. Now, that's going to create a feedback loop in the direction that they're hedging the exposure, to the upside or to the downside. If the price moves up, they have to increase hedging. If the price moves up, they have to increase even more hedging until the calls expire at a certain strike or a certain date. Then the volatility completely collapses, or the price stalls below the strike clusters. And that's when the feedback loop breaks, and it doesn't break diplomatically or politely, it snaps just like that. It snaps just like that. It breaks just like that. And by the end of that move, you see exactly where the pressure leaks and around which prices these markets settle around, because that's where it's reached equilibrium and where the price and supply and demand are all in sync, and all of that negative flow has come out of the dealers' books, and now prices can start to accumulate and remove in the direction that they were moving before. But there's another part that many people miss. Silver is small, silver is very illiquid, and the silver market is tiny compared to that of equities or bonds or foreign exchange or gold. That means it doesn't really take that much to distort the price of silver, which is why you get all of these conspiratorial, or maybe not so conspiratorial, stories of banks and institutions and hedge funds and the moneyed classes manipulating these markets, because it can be moved. It doesn't take much in the way of option flows to distort the price. And when the metals start moving mechanically, it often precedes stress elsewhere. Think back to 2011, if you would lend me your ears and your memories. Silver peaked before broader risk stress. In 2020, oil snapped before the credit panics. And then in 2008, commodity volatility surged before the equity collapsed. Metals are the pressure valves. They move first. They move because they're thin, they move because they're highly leveraged, they move because they're hedged aggressively for a variety of reasons, for speculation reasons, for hedging flows, for producer flows, for swap contracts, for central bank buy-in. So it's all the barometer and the thermometer of the market, and it's often what breaks first. Now, I hate to be alarmist or fatalistic or to catastrophize, but there is an inevitability to all of my videos and most of the things that I say. And it's not about being bullish or bearish. Start getting that out of your mind. You're trading price action. You're not trading your sentiment or your emotion. You're just trading the cold, hard reality of what's going on. And the truth is, it's mechanical. Price is driven by gamma. Price is driven by options flow. And it happens in one of three ways. It can accelerate into a squeeze. It can have a sudden volatility crush and stall. It can have a violent reversal once the positioning clears out. There's no smooth outcome in these markets. If call positioning keeps rising, if call positioning keeps building, the dealers have to do one thing. Now you should know it. I've been beating it into your head ad nauseum. They have to chase the flows. They have to chase the futures market. If they're selling calls, they have to hedge it by buying in the futures market. If the air pocket clears suddenly, that's what causes price to collapse. Either way, the instability is going to increase, and the system doesn't like instability, which is why the margin requirements from the CME have to change. You get liquidity injections, you get people coming out making speeches, you get people coming out trying to pacify the market or placate them, of volatility suppression often following afterwards. The antagonist isn't some boogeyman in the background, some central banker or some hedge fund manager who's in the background saying, hey, let's crush the retail. It's the structure, it's the mechanism, it's the organism, it's the system itself. Now, I understand it. I'm a retail trader, and I'll also probably say the same thing as everyone else. Silver is finally breaking out. Silver has gone over those SMAs and those EMAs. It's moved past that fib level. The RSI is primed and the MACD is all showing bullish trajectory and telemetry to the moon. But the professionals will say, who is short the gamma? Where is the max pain? Who's short the call? Who's short the optionality? Who has to buy more to hedge the position, and how do we squeeze them because of it? Retail are going to ask, is this the new bull market? Is this the start of something new? Are governments losing their credibility? Are we being debased? I mean, these are all valid questions, but the dealers are asking, where is the strike concentration? Where are the strikes clustering around? Where is the max pain? Retail is going to be trading the story, but the system trades the exposure. The system trades the gamma. It trades the flows, the hedging flows, and it understands and calculates where it can ride the wave of those things. Because selling calls to a buoyant, happy retail market, or even an institutional market who are anticipating and trying to price a thesis, is very profitable. But it's also profitable to understand where the futures flows are going in terms of riding that price and understanding, more importantly, where the reversal comes. Now, there's a few things to watch. Strike clusters, short-dated call concentration, rising implied volatility, open interest expansion. Now, if silver stalls below major call walls, then the gamma has to flip, obviously, because less people are going to be buying it and the dealer flows have to switch around completely. So if retail stop buying calls, dealers stop selling them, they don't need to hedge them anymore, and therefore the market readjusts. If it rips through with increasing open interest, the squeezes are always going to continue. But once the positioning peaks, that's when the leak has to begin. And by the end of the move, you'll definitely know which kind of regime you are in. Now, what's the resolution and what's the conclusion to all of these things? Is it impossible to trade silver without knowing the gamma flows? Is it impossible to trade silver without understanding the institutional buying of futures that hedge their exposure? Is it impossible to know what's going to happen next if you don't understand the pressures on the system and where the CME are probably going to come in and whack you out? Well, it's not impossible, but it's just a bit harder. The move in silver isn't about belief. It isn't about coin shops. It isn't about grandma or grandpa stacking. It isn't about retail stacking. It's about gamma. Gamma, gamma, gamma. The price is led by the gamma, okay? And gamma doesn't care about narratives. Gamma cares about flows, and it cares about exposures. It cares about hedging actions. It's a hedging engine. It's a hedging monolith. It's a hedging behemoth. And believe me, those combinations of words are harder to say in quick succession than you ever would have believed, because I'm stumbling on it right now. But when the engine runs too hot, just like any other engine, it's going to explode or it's going to seize up violently. One of the two. But in the option markets, it's either going to explode upwards or it's going to seize violently. But silver isn't signaling demand. It's just signaling stress on the system. That's why you see people looking for deliveries of silver in real actual ounces, buying contracts that end in delivery, people willing to have price dislocations in certain geographies, like the price of silver in Shanghai versus the price of silver in London or in New York. But the stress is going to leak somewhere. And where it's going to show up first is in the option pricing. Now, if you've liked this video, give me a share, give me a like, just give me a subscribe, or send me some silver. Who knows? I don't know. But bottom line of the video is, gamma is what moves markets. Hedging is what moves markets. Futures exposure is what moves markets, not the retail price, not the retail buying. Get that out of your head and start to think institutionally. And you'll thank me for it later, or you'll thank yourself for it later. Either way, my name's Justin Banton. This is the House of Trade. Ciao for now.